everybody. Welcome to another Learn It Live webinar conducted by FX Evolution for Pepperstone. Tonight we're going to be doing scalping using stochastic and MACD indicators. Very exciting. I know a lot of you guys love our scalping webinars, so we've got some kind of recent examples to show everybody maybe a few strategies they haven't considered before. They're quite basic and easy to implement. And my name's Thomas Atkinson, as always, joined by Tyrone Abella.
Hi everyone, and welcome to tonight's webinar. We're going to be using a couple of the most, or our favorite indicators for scalping for sure, and some of the more popular ones that are very popular for users. So we'll get right into that very shortly.
Just before we start, we always need to go through risk warning. So obviously the information provided in these webinars has been produced by a third party and does not reflect the opinion of Pepperstone. The information has been provided without any alteration or verification. And of course, the information contained in tonight's webinar should be considered only general in nature and for educational purposes only. Okay, so let's talk about what we're going to be covering tonight. So we're going to be taking a look at identifying the timeframes that scalping strategies work best on. This is one that I find a lot of people do struggle with. We've talked about it many times over the last couple of years, how everyone usually gets started on potentially the tick charts or even the 1 minute charts, Ty. But really scalping in our opinion is probably more like a 5, 15 minute to 1 hour kind of chart time frame. So we'll talk about that tonight. We'll then be looking at how to build a scalping system based on a points-based approach. We do this again quite regularly, but the importance is always have a business plan for your trading strategy. So very, very important to have a business plan for everything and a points-based system. Just before we get started, can everyone hear me? And Tyrone? Few people say they don't have sound. Appreciate anyone's response in just the questions window.
Yeah, I think everybody's okay. Yep, it's okay. Just a couple of.
Oh yeah, yep. No, perfect. Just a few people that have it muted.
Okay.
Great, no problems there. Okay, so then we also want to be looking at how to identify correct market conditions. Very tough, often to do when you first start trading. It's often because you don't use multi-time frame analysis. So we'll be talking about that. And then popular indicators that you can use alongside stochastic and MACD. So the main one we're focusing on, we always talk about, is going to be moving averages. We will give everybody the moving averages. We get asked it all the time. A lot of guys that have been coming all the time know which ones we use, but we will mention it briefly again. So Ty, before we actually even get started, I want to actually jump straight into the charts and just talk about this New Zealand dollar. So New Zealand versus US dollar. Here we've got a chart, and we can all very clearly see it would not take a rocket scientist to tell that at least recently it's been in a bit of a downtrend on the daily. So the reason I wanted to bring everyone onto the daily is a lot of your analysis for scalping a 15-minute or 5-minute time frame, you still need to look at the larger time frames. It's so often not looked at. I remember when we first started, Ty, we often would just sit on the smaller time frames because it's more exciting. We all love scalping. We all love being in and out and making, quick kind of trade and not having to be in the market for too long and watch and kind of fret about what's going to happen. But if you don't understand what's happening on the larger time frame, you don't know where the big money flow is. So let's consider this New Zealand US dollar pair, and let's just say we were here last week. When we were here, do you think that we should be buying on the scalping market or potentially selling, Ty? I mean, clearly to us, we're going to say we should only be looking for sells, and that's just because of what we've seen happen before this precedenting event. So we know that the price is under, this is the 200 moving average daily, and we know there's a cross of the 20 and the 50 moving averages because we use 200, 20, and 50. And we know that it's in a bit of a downtrend. So looking more for the short-term sell scalps on the 15-minute timeframes or 1 hour timeframes is going to generally be more successful than buying and counter trending. We all love the counter trend, but generally speaking, you're better off going with the trend. And as many people out there will know, trend is your friend. So Ty, do you want to talk more on that subject of just making sure you always check that daily 4 hour before you jump into the smaller timeframes and how important it is?
Yeah, look, when you're checking the Well, the 4 hour is an absolute minimum for scalping. I mean, if you're going to be trading the 15-minute and 5-minute and even 1 hour charts, the 4 hour is the absolute minimum, or like that's a minimum time frame you want to be checking. Ideally, you want to be in the same direction as the daily as well. But if you've got the 4 hour in your favor, it is going to be a very, very big plus. Now, a lot of people think, well, why would a 15-minute chart, really have any relevance to what the daily is doing? But it's more really, it's market flow and momentum that is going to help you along the way. What that means is that if you're trading in the direction of the 4 hour or the daily trend, what you're going to be able to do is not exactly pinpoint every single position to the exact pip to make sure that you get or to extract the most amount of pips out of it. And by that I mean, if you are counter trending, if you're going against the overall trend, your entry points have to be pinpoint accurate, and also your exit points have to be the same to really be able to get bang for your buck. And by that I mean, the risk and the reward ratios obviously need to be in line with something that's acceptable. So when you're counter trending, often they're going to be quite small. So risk reward is generally going to be probably 1-to-1, 1-to-2 at the very, very most. Now, when you're trading in the direction of the trend, that's far more achievable. Okay, so your entry points have to be anywhere near as accurate, and your exit points also have a little bit more leniency. So that's why it's really, really important. But for a 15-minute or a 5-minute chart, at the very, very least, you want to have the 4 hour going in your direction. It doesn't have to be a super trend like the one we've just had a look at, but it's got to be, at least having a series of lower highs and lower lows if you're trading down, or a series of higher highs and higher lows if you're trading in an upward direction. It makes your scalping so much easier, even if you are only going for a handful of pips.
So let's talk about this particular pair here, Ty. We can see that it's sold off. Now, let's say we don't bother coming into this trade and even considering shorts on it, potentially to maybe this point here, okay? So where it breaks under this support resistance. When that happens, we then jump on our 15-minute time frame and say, okay, this looks very short, it's broken through our 200 on the 4 hour, all very important things that happen. It can be as basic as that. And then we jump down to the smaller time frame. So let's say we go down then to the 15-minute and try to create a bit of a plan of what we're going to do with trading this system, or trading a basic kind of indicator alongside this. So one of the ones we're going to add is MACD. So we're just going to add the basic MACD indicator that comes in MetaTrader 5 with the Pepperstone platform. And then we'll jump into some theory here, and we'll get back to this chart, and we'll talk about this one and another one and the importance of setting it up like that. So we'll just quickly go back into the slides. And then we'll just talk about some recognizing market conditions. So one thing we did there with the live charts is we recognized that it's in a trending market. We did so by basically saying, is price above or below the 200 moving average? And, of course, just do a bit of the eye test. Has a support or resistance line that's fairly important on those time frames being broken? If that's the case, then we're in, let's say, a trending market, and we're going to apply our trending strategy. Now, we'll take a look at a channel or range-bound market a little bit later in this webinar tonight, and we'll talk about how to identify one of those. But if you don't know, recognizing or learning about channel patterns is fundamental to all of your trading, and it's very, very important that you learn that before pretty much most other things, Ty. I think learning basic support resistance is so important, even if you trade heaps of different indicators, because it still tells you a lot about the market psychology and where the market's going to stop or potentially stop, and where it is going to find, resistances and supports. But in this case, we identified the trending market. A few questions about the 20 and the 50 and the 200. So 20 and 50 are EMA, and the 200 is an SMA in our charts there. So MACD, Ty, one of your favorite indicators. I'd say potentially your favorite indicator totally. So MACD stands for moving average convergence divergence. Ty, do you want to just quickly walk us through the basics of this?
Okay, so the MACD indicator is useful for long-term and short-term trades. Okay, so it is just as useful for scalping as well, which is why a lot of people really, really like it, because it gives you the market momentum in any time frame very, very quickly at a glance, especially when you understand what the histogram is actually trying to tell you. So here you can see that we're drawing each cross of the 12 and the 26 EMA. So on the chart that we can see on the screen, the red is the 12 EMA and the blue is the 26 EMA. So as you can see, every time those EMAs cross each other, the histogram goes from negative to positive, so below the zero and above the zero. Now, as those two moving averages start to accelerate away from each other, so more importantly, as the slower moving average is going down slowly, the faster moving average of 12 is accelerating away, the gap is getting bigger between the two. And as the gap gets bigger, the histogram gets bigger. So as you can see, the histogram is growing bigger and bigger as the gap gets bigger. Now, when that starts to turn around and the speed of the 12 starts to slow down and starts to, basically start to work up to the 26 again, the histogram starts to get smaller. Okay. Now, when we know what we're looking for with MACD, we don't need the 12 and the 26 moving averages obviously on the chart. We've put it on just as an example. But when the MACD's normal setting, the default setting on MT4 and 5 is a 12 and a 26. These are the two lines that are causing this histogram to basically appear the way it does. Okay. Now, when we're looking for things like divergence in MACD, which is a very, very popular method even for scalping, what we're looking for is isolated differences of the peaks and the troughs of the MACD histogram, where the moving averages that we can see on the chart have actually, although price, say for instance, has made a new high and the histogram hasn't made a new high, we know straight away that the moving average is, they're closer together at the second peak than they were at the first peak, causing that divergence. Okay, so even though it's on a small time frame, it's still showing weakness in the market. The moving averages are not basically confirming what price action is actually doing, which means that price action's forming probably a little bit of a false signal when the MACD isn't really confirming. So the moving averages are not confirming what price is doing, and that is an isolated weakness. And same goes for the reverse. If we've got a couple of troughs on the MACD and price is making a new low, and the MACD fails to make a new low in its histogram, we know that the 12 EMA has actually slowed down on the second peak quite significantly, as you can see here. And that's signaling to us that although price has gone and made an equal low or a lower low, the histogram has not followed. So there's an absolute weakness in the price, and more than likely it's going to reverse for you. And that can, like I said, that can happen on a 5-minute chart, on a 15-minute chart, or a 1-hour chart. So it's a really, really good indicator to apply to whichever time frame you are trading.
So here's just a little bit about how to calculate a MACD. We're not going to go into this too much tonight because we do assume some, almost a little bit of base kind of knowledge. But for anyone watching this on YouTube later, you'll be able, or on maybe the webinar after, I think, recording, there's your calculation on that one. So here's just a really basic kind of rule to follow. So let's say we had two rules, because rules are really important in any type of trading strategy. The first rule is go long when the MACD line crosses from below to above the signal line. Okay, so let's say that was one of our rules. The second rule was go short when MACD line crosses from above to below the signal line. So let's just say they were our two rules, and we're going to keep it really basic, and we'll just see how this applies to the market. So here we've got a bit of an option in terms of the signal lines and what would be happening if we were getting into the trade. So here, Ty, we've got the A, B, C, D, E, F, and G. Do you want to explain just quickly what we're talking about here?
So the signal line that we're talking about is the 9, which is basically a moving average of the other two. So the red line that you see on your MACD indicator is a signal line that we're referring to. So when that exits or enters the histogram, they're the signals that we're talking about. So if it's exiting the histogram from above, that rule would sell. And if it's exiting the histogram from below, like it is in F and also in D, that would be your buy signal. So basically what you're looking for, and on the other rule that we were talking about, actually buying when the signal line enters the histogram above, as it is in G, and also in C and B and A. Actually, quite a few of those.
There's quite a few of them here.
Yeah, so they're the two rules that we just talked about. And look, they do work well in most timeframes. We don't necessarily use those, because that's basically, it's a very, very basic scalping strategy that, yeah, that does work if you're looking at the very smaller moves in the market. We generally go a little bit bigger, but in a scalping sense, those two rules do actually work quite well.
So they're just a couple of rules, but let's now go back to the market, add on our moving average or MACD indicator here, and just have a look at how the market has actually interacted over the time of this sell-off tie. So one thing I was looking at before, and I thought, you know what, got to point these points out, is that we've got here again the same moving averages. So we've got that 200, the 50, and the 20. And what a lot of you may notice is that the market often comes and touches this 200. And there is a reason for that, but this often is a very touched zone in aggressive trends. And a lot of robots and algorithms, and even a lot of larger time frames, you got to remember this 200 kind of correlates to a lot of those larger time frames, because as you go up time frames, the 200 is equal to one of the smaller time frames on the bigger one. So here we've got the 200. We notice that we're in a bit of a downtrend. Maybe we're not interested in this one because we don't see it yet. But when it hits this one simple thing to do, Ty, and we've done this quite a lot over the years, is literally to wait until the histogram here goes from the positive to the negative. Now, you don't have to do that, but by doing that, what it does is it kind of saves you just guessing that it's going to be turning around. So you don't get necessarily the top, but you do get in when the market is literally saying, okay, it's time to get into the market. We're crossing from the positive to the negative. And you'll see why that's so important later on when we talk about getting the safety net that you need in the market. So 200 has been touched. We can see it respected it. It's then sold off. The MACD has crossed, in this case, from the positive to the negative. We get into the market to the sell side, place our stop up here, and start following the trend. And what you'll notice is that when you're in aggressive trends, or you're in trends in general, is that this strategy can work quite well, because what it also does is it gets you in a few times. You end up getting this kind of thing that happens here at the end of the market, where the end of the trend kind of occurs on the 15-minute. Now, when you place this trade, you really should be, of course, putting a stop loss above the highs. So you actually would have held in for a while, and you can see it goes on and easily gets you over a 1-to-1 risk reward kind of trade down here. Now, the importance of waiting for that MACD cross is because when it hits the 200 this last time, notice how it breaks through and there's no cross back from the positive to the negative on the histogram. Very, very important when it comes to scalping. It saves you from actually losing money and just guessing that it's hit the 200. So not every time, it's eventually going to break the trend. That's the nature of it, especially in scalping. So the key is to recognize that you're in a trend in the first place. We can do that with those basic rules we talked about before. Then we can go into the 15-minute, and maybe we set every time it hits the 200 and then it crosses from the positive to the negative because we're in a downtrend, we just look to sell. As simple as that, Ty. And that can make up one very basic but actually quite successful trading strategy without using a whole bunch of different indicators. I mean, I think, well, you and I have definitely done this in the past. So, I mean, how do you feel about this one?
Yeah, and look, you're probably hitting the nail on the head when you're saying that you probably want to keep your scalping strategies fairly simple, because the thing is, you want to be sort of in and out. You don't need to be spending, hours and hours of analysis to place a lot of trades, because scalpers generally trade a lot more frequently than longer term to middle term swing traders, of course. So you need to be able to base decisions on fairly quick information. And what we've just talked about there is, it's actually quite robust. I mean, it's probably more robust than you probably realize, because you still get that confirmation that you're after, even though you are scalping, and it does take away a lot of negative trades that you would otherwise get caught in, no question.
So here we've got the pound US dollar, and we can see, again, it doesn't take really a rocket scientist to know that at least when it got through this point. Now, somebody did ask, do we use support resistance? Absolutely, we do. If you're looking at a chart like this, of course, there's a lot of support over here. A lot of the support was broken here. But generally speaking, if you don't want to go through support resistance too much, if the price is underneath that daily 200s, very, very important. You start to see that sell off, look more for the sell side of things. So let's say we jump down here into the 15-minute again. So we're going to do really basic analysis like that. Jump down to the 15-minute. And what we're going to do is we're literally just going to look at that 200 again and see whether there's crosses to the downside and whether they would be successful. So here we've got touch of the 200. Okay, so before it did get through it, you'll notice that when it did go through, that histogram you didn't get back in. Remember, very important to always proof your scalping systems. One thing it's too easy to do is just say, oh, well, I'd always be, this one's right, this one's right, this one's right. We've all had a system like that. And then we forget about the fact that we would have been stuck in all of these other trades. And that's something that we need to be really accountable for when it comes to scalps. We need to make sure that we'd be able to do the same thing replicatable and we wouldn't be making mistakes. So here we've got the 200 being touched. You can see the crosses every time the 200 is touched. And then more importantly than anything else, notice here when the 200 is touched over here, notice how it stays, the histogram stays high and you do not have a short opportunity. So you don't get, more importantly, stuck in this zone where you've shorted and you've said, okay, I think it's going down. You may be correct on the longer term time scales, but on the scalping, you don't get stuck in it. So Ty, I mean, to me, it makes so much sense for people that don't have much of a kind of system in place yet, just to keep it basic and keep it like this, because the histogram just by crossing is literally saying there is some confidence in shorting it to the next level. And the market generally gives you a way out, doesn't it?
It does. And look, and the good thing about moving averages, they do very rarely lie when you're looking at that consolidation. Like for a histogram to actually go negative, we obviously have to have a cross. So, or if it's going to go positive, we have to have a cross to the upside. So as much as it can ribbon a lot in smaller areas, when it is actually got a little bit of a trend happening, it can be fairly reliable. So, I mean, you obviously have to keep your expectations in check. So, I mean, if you're trading a 15-minute chart, you can't be expecting that you're going to make 150 pips. So, you've got to keep your expectations in check, of course, but it does help when the trend is in your direction and it's being backed up by the moving averages. Now, I'm actually getting quite a few questions about price action. Do we use it? Look, absolutely, we use it. We use it a lot, but we're not going to focus on price action tonight because that's really a whole other webinar, actually, and we will do one on that in the coming weeks. But what I will do for the people who haven't done our module 1, we've got a price action module that has been very, very popular. A lot of people have done it. I'll pop it in the window. Our last one recently expired, but we've actually got a new one for September to try and get as many people as possible to do this price action module, because it can be very, very beneficial for your trading to help identify the direction of the markets in the short term and the long term. So I'm just going to pop that in the chat window, and everybody's free to just click on that link and do that module for free.
A few people asking about stop losses and take profits. Good thing about strategies such as this, very simple for the stop losses. So what you want to be doing is, let's say we get involved in the trades in these locations. We'll just do it as an example. We would want to place our stop loss above this zone here. So above this. Now you don't ever want to do it by a few pips. I know a lot of books and a lot of theory will teach you a few pips. Problem is, market guys and makers and things like that, they do know these rules and these tricks, so they'll usually push it a few extra pips to knock you out. And that can be, well, there's nothing more frustrating than that, Tyrone, I find. So maybe what you'd like to do is you take kind of something as simple as maybe going the last candle here, and you take the range of that candle, maybe that candle is 10 pips long, and maybe add a percentage onto that for your stop loss. Or you can take maybe the last pull. So it's good to have like a market adaptive stop loss that's based on percentages. So maybe the candle, you take 50% extra behind, or on a daily, you'll take usually 15% behind is a really, really good level. Again, here, you would take a percentage behind. So that is a very, very good idea to do. I always like breaking it down to percentages. I mean, Ty, I think you agree. Percentages are market adaptive, nothing better than that.
Yeah, that's right. Absolutely. And it really keeps you in check. If you start to count, dollar value or pip value, you're going to start letting psychology creep in, which is the one thing you certainly don't want to be doing. So percentages is always the cleanest way, because it allows you to scale your trades and your accounts, for that matter, a lot better in the future.
So we can see this one here is, it looks like 19 points, kind of long. So what we would do is probably, well, let's just call it 20. We'd probably say let's say maybe 5 pips. So maybe 25% of that would make a lot of sense. And then we'd set that as our 15-minute stop loss, 25% of each one of the previous candles for the high. Now, in terms of take profits, there's a few ways, again, you can do that. It depends on the strength of the trend. Generally speaking, I actually do like to bring price action into this one, where I look for stop kind of like support and resistance on the higher time frames. But if, like, so say like this one here, if we were looking at the pound, I'll just quickly get rid of these drawings. I know we said we wouldn't talk too much about price action tie, but I've kind of got to here for take profits. The best thing to do is always to look at the previous kind of support resistances. So here we had some support. We also obviously also had some support here, and it looks like we had some support here. So these are the kind of levels that you'd be wanting to set potential take profits for. I like to use a line chart just to kind of smooth out the close prices so that you can see a lot clearer where they're going to be. Two things people like to do. One is take the moving average cross back over, maybe of the 2050, so hold it in until the end. I kind of like that, but oftentimes it'll kind of look like it's crossing. You've got to be very patient and make sure it doesn't. But yeah, let's say we took this first one, looks like the cross would be out here, so it wouldn't be too many pips. It'd probably be about 40 for 25. It's not too bad. In terms of this one here, it would have been most likely a lot more successful. So you're looking at something around 150 pips. Now, if you get that and you've only got a stop loss of probably about 50 or 60, then in that case, you're getting a 3-to-1 type of trade. You can often afford to take a little bit more losses because, of course, 3-to-1 pays off quite a lot of poor trades. But more importantly, it gives you really good risk reward. So that's a few kind of ideas that we like to do. You'll have to come up with your own one. Generally, support resistance, though, is perfect.
It's always the one that seems, yeah, it does certainly work really, really well. Now, we've got quite a few questions coming in about which currency pairs or trading instruments this actually works on. Okay. The good thing about technical analysis and the good thing about indicators is once you understand what they do, they basically work on everything that has a chart. Okay, so you can be doing this on the Euro USD just as easily as you could be doing it on gold, silver, or oil. The indicators that you're seeing give you the divergences or even just the signals to get in or out is a primary function of what the chart is actually doing, what price action is actually doing. Because at the end of the day, it all does go back to price action. And when price action is being diverted away from what the moving averages are telling you, it doesn't really matter what instrument you're trading or what time frame you're trading. For that particular thing that you're seeing, it's going to work the exact same way. And that's another reason why it's really important to really focus on percentages as you take profits and stop losses and go for support and resistance, because then it makes it very market adaptable to whatever you're looking at. So whether you're looking at gold or silver or any of the currency pairs or indices for that matter, you know, you're actually using things that actually are a factor for that chart rather than just, you know, a standard number, which, you know, doesn't really work in the long run.
A few other good questions here that I just think are so valid. A few questions about what is the best trading zone for people, I guess, in the Asian trading kind of times. There's no question in my mind that London Open is the best trading time. You get great economic news coming out, which often pushes the markets. You get a little bit of fake out at the beginning. Usually I like to get started about half an hour before London Open for my analysis for the scalps, but it's perfect timing. It's also generally after hours. So if you do work a full-time job, it's really, really good. So I have to recommend London Open, one of the best times. A few other questions about London Open, what time it is. It will depend on daylight savings time for both countries. So always make sure you even just search in Google time in London, generally it's around 8 a.m. So just to make sure you can see that.
Failing that, get into the New York Open. It's the New York Open is also a good one.
I mean, not many people can get into the New York Open if they live in Asia. It's a bit difficult.
Just depends on where you're from. But yeah, bad. Yeah. The only market open that's probably disappointing is probably the Asian Open. Okay, that is a little bit disappointing in terms of big movement because it very rarely, you know, really electrifies anything. But when you're looking at the London and the New York Opens, they are generally pretty good movers, and you do get sometimes trends that can last quite a bit of time.
There's some really good questions in here. I might even answer a few of these, Ty, because we have covered a lot of this content before, and I just think this helps people.
Yes.
So a lot of people, talking about kind of getting stopped out and then chasing their kind of orders, and they get stuck into a bit of market exhaustion. It's very much what's happening here on the pound. So let's say you miss these shorts. What always happens is this, okay? So you're looking at this daily and you're looking at the charts, and we'll just get rid of the MACD for a minute, get rid of these lines. And most people, this is what happens. We see it all a little bit too late. So it comes in, it becomes painfully aware that it's in a short here around this point, and then everyone starts selling, okay? And it happens on the Australian dollar all the time, happens on all currency pairs. You might be waiting, let's say, for the break of this, the break happens, you go, oh wow, the break's happened, you start shorting in here, and then it starts doing this kind of channeling and bounces around and sticks you a little bit on that. That's why we say when you get that cross below that 200, especially when it breaks through here, at all the time you're looking for shorts, okay? Literally that one thing will completely change your trading. If you do that and you just look for shorts the entire time, you'll generally have more success. Look how long the currency can stay under this or above this. So if you were sitting for years and you were literally just trading the pound to the long side, do you think you would have been more successful or less successful during the period of what's this? Looks like April 2017 all the way to May 2018, so over a year. You will have been more successful following just buy positions. And that's because that's what the bigger market and the general overlying market is doing. It's pushing it there probably due to economic news, due to what the Reserve Bank of that country is doing. All these things you don't even need to care about. If you just follow the technicals and just follow even that basic kind of MACD switch, you'd be surprised how much more success you'll have. So that's definitely one thing that will help you.
Yeah, and I've actually just had a comment saying that the pound is actually a pretty good example on a 15-minute chart on what a London Open can actually do. So it might pay to even have a look at that to just give people an example of what it can actually.
Well, here we go. Yeah, I mean, look, this is kind of the exhaustion that's happened in the market in terms of it's been selling off, and we've now got that big move. We proved on the MACD indicated that it would not have let you in because it's the histogram stayed above and didn't come back. But now we're seeing a very nice breakout that's happening here towards the upside for the pound. Now, we'd still be predominantly short and looking for shorts, but if you were countering, or if you were somebody that said, okay, I'm going to sell this, you have to wait till the market tells you that it's going back down. You can't just say, oh, I think it's a sell here, because what's going to happen is the market is usually going to, unfortunately, continue to go up when you least expect it.
That is a good example of what can happen at a London Open.
But this is what often does happen in London Open. So I just wanted to quickly bring up a example of a channeling market so everyone can see that as well. I know we are obviously always time limited on these ones, Tyrone. So here I've just tracked price on the US 500. This is just the 4-hour. The reason I wanted to track price here is I think everyone can see that price is trapped. This is a good example where you can then add something like a stochastic indicator. So stochastic oscillators work incredibly well when it comes to trading channels. So it can be as simple as when you see a cross of the stochastic from overbought from overbought here, and you see the cross come down and it's at the top of your channel, it can be as simple as literally selling at that point. And you can see over here, it did it again. And you can see over here, it almost got there. And how we usually analyze this is we want to look for a few touches. So I always like to say one touch to each side. And then on the second touch to each side, we can draw our channel and we can say here, price is trapped. So usually the third one is actually the best. So this is the third one here. Very good trading on these. So third is like a double tick. Very, very nice kind of trade, because everyone's seeing at this point, and especially the bigger traders, they're going to be analyzing this and saying, okay, looks really good up here, and it's going to look really good up down here, because we've already seen the pattern or the event occur. So once you get those two touches to each side and they look very clean, then you usually can trade the channel, especially on the third one. I find it's quite successful. You can use things like stochastic from overbought to oversold, works quite well. You can also jump into the smaller time frames. So you might analyze this on the 4 hour, jump into the 1 hour, jump into the 15 minute, and look for maybe little patterns and things that happen in these as well. Does that make sense to everybody? What I'm doing there with the channel? Can everyone see why at this point here, most of the market kind of players will be analyzing this and saying, okay, we're stuck in the zone?
Good. You're getting a lot of yeses, so that's good. Yeah, everyone can see that. That's great.
Oh,
Cool.
awesome.
Yeah.
But I
I'm
know it
also
sounds
getting a lot of
simple, but
questions.
a lot of people don't do it.
A lot of people don't do it. Yeah, that's right. I'm getting a lot of questions about analyzing different pairs. Look, we're not doing that in this webinar because this is primarily a teaching one. But if you'd like to follow us in the pairs that we're actually going to be doing analysis on tonight, we've got a webinar starting in 25 minutes from now. So I'll pop that link in the chat window as well. So anyone who'd like to join that webinar, that's going to be more a live market analysis where we actually analyze a lot of the pairs that everyone's asking about. So I'll pop that in the window now. So feel free to jump in on that one if you like. That starts in 25 minutes.
Maria's got a good question here. Using RSI would be similar on this channel. Yes, it definitely would. Stochastic and RSI will show very similar signals, and that's a warning to everybody as well. If you're using both of them and saying they both, oh, look, I've got two reasons to be in the trade, funnily enough, both will actually agree usually on the same trades.
Yeah.
So, yeah, definitely on that one. All right, we'll jump back into the slides for a second here, Ty, because we do need to cover a little bit more content if possible. So here's the stochastic oscillator. We can see here overbought and oversold. We've got the K line and D line. Don't have too much time to go over all of that, but here's some basic rules. So this one is go long when stochastic moves down past the oversold level, then rises back above, and then it goes short when the stochastic moves up past the overbought level, then drops back below. So that's definitely something you can do. What most people know stochastic though, there's heaps of information out there. You can check that out. So when you're building a strategy, and this is just an important part I wanted to do on this webinar because scalping is so important to keep to your rules, we need to have some reasons to be in the trade. So before we saw that we had a trending market and we had the MACD indicator, and then maybe we would have had support or resistance in terms of a break that we could bring into it. Now, let's say we had all those three reasons to be in the trade. If we have all those three reasons, we could meet our minimum 75 points. We could have this literally just laminated on our desk and just tick it. A lot of people just have it maybe in a spreadsheet and just fill it in and be accountable to it. But you have a few reasons to be in a trade. Never have just one reason. You want to have a few reasons. One thing that we do in our course that we obviously do sell and have written ourselves is we talk about our pressing system, which has so many reasons to be in a trade, because you need a lot of reasons, because then you need all those different types of traders to come on board and get into your system. And when you get really good at scalping, good at trading, what you'll see is you might be in before all of them, but then you'll see the cross of the moving averages, and you'll say all the guys using some kind of indicator that signals for them to buy or sell. When that cross happens, they're coming on board. Then you see a break of that support, they're coming on board. Very, very important. So try to build a strategy, have some points. Risk management, 1 to 2% obviously is where you should be looking at risking of your account balance, no more. It's not rocket scientist kind of material. Again, everyone says this, but it is really important to stick to it, because it's about compounding your profits long term. And if you're getting 3 to 5 to 1 trades, you'll have a lot of success long time. And you will do much better than fund managers and all those kind of guys out there. You do have a distinct advantage actually not having a huge amount of money. When you get into billions of money, billions of dollars of management, it's actually quite a lot more difficult than you expect to trade. A couple of $100 million is not too hard, but billions is difficult. Not basket trading, so not trading too many of the same pair in the same direction, and of course following your strategy. So Ty, I think what I wanted to cover tonight, we're not going to be doing everything, but we always are doing these webinars, so we encourage you to come along to either our one or of course the Pepperstone ones that we run every 2 weeks. But hopefully a lot of that stuff makes sense to you. I do want to get a few more questions out there, and I also wanted to talk just a little bit about trading liquid pairs and looking out for red news. So if you're scalping, please make sure you look to trade big major currencies. You've really got to trade currencies that have huge amounts of liquidity and huge amounts of robots and people actually hand trading them. So things like the euro US dollar, things like the pound US dollar yen, US dollar CAD, those kind of positions are going to be very, very good. Euro yen, that type of stuff. If you're trading the exotic pairs, generally scalping will be incredibly aggressive on those, and you'll get a lot of stop outs. You might get big runs, but you will get a lot of stop outs, and that unfortunately can really hurt your confidence, and that's generally where people blow accounts because they start moving their stop loss, and it all goes very bad very quick. So try to trade the more liquid pairs if you can, and look out for red news. So this week, if you're trading, I would probably suggest you don't scalp on the Friday. Now, why is that, Ty? What's happening on Friday?
Friday is non-farm payrolls.
Yes. Yeah, Tony got it. Tony knows. He said it before you even said it, so it didn't work. A few of them Henry did as well.
I actually just checked my calendar to make sure. Actually, I lost track of the date there for a second, but yes, yeah.
I'd say this non-farm payrolls will be a pretty important one. We're looking at a potential another rate cut. It will significantly move the markets. It's going to be a good one to watch, actually. For anyone that's getting into trading, a few beginners here I know, don't necessarily trade, but watch this week's non-farm payrolls and watch the way the market interprets the figure, because it's a difficult one for the market to interpret, and often it'll go up and down 100 pips, and then at the end it'll end up very similar to where it was. Sometimes it's steam rocket somewhere else, but non-farm payrolls is a scary bit of news that's often hard to interpret by the market.
At this time in the market cycle, they can't work out whether they actually want the numbers to be good or bad, which means that the market's going to go up and down in a very big hurry and probably end up in the exact same place that it started. So yeah, very, very interesting, that one. It's going to be a good one to watch, actually. So keep an eye out, but just be mindful that they don't know what they want. They don't know whether they want a good result or a bad result at the moment. So the market could react in a very strange way. I'm having a few people saying, sorry, just quickly, a few people are saying that they can't see the link for the webinar that's starting a bit later on. Just check the chat window. So underneath, you should see a little chat window. There'll be a registration link with a GoToWebinar registration link. So you just have to click on that, and that'll get you to the registration page.
A couple other questions here. Do you think pound yen is too aggressive for scalping? No, I think pound yen is okay. It is called the Beast. It has got the nickname the Beast, but I think it's okay. I do think though that if you're a beginner, you're probably better off sticking to those the real majors. You'll generally have more success. Non-farm payrolls is USA news, by the way, Craig. Yeah. Now, another little announcement I guess I wanted to tell everybody is that we're looking at doing a bit of another cheat sheet. So we do have a cheat sheet that is available at the moment, but and that's on patterns, but we are going to probably be doing a cheat sheet on MACD and divergences. So if anyone wants to hop over to our YouTube channel, we're just kind of starting off on that one. We haven't really been in the YouTube space that long. You can just subscribe on the link I've put in the chat on the YouTube channel. We would appreciate that. And we will be looking to send everyone that does that and does the webinars a little cheat sheet over the next coming month that we'll prepare for everybody. So that'll be a really good one because it'll show you all the different types of divergence and really give you a great thing to put on your wall or just have on your computer next to you, maybe on your big screen where you've got a few different cheat sheets there. So hopefully that will help everybody. We'd appreciate that though.
It will be a good one. Anybody who actually wants the the first cheat sheet. If you haven't got a copy of that, just send us an email at support@fxevolution.com, and we'll get you that cheat sheet, the one that's already available. It's quite a popular one actually. So yeah, feel free to send through an email, and we'll get that to you.
So just to recap tonight, we've answered a few questions. We did go a little bit off topic, but basically scalping, you can probably tell MACD is one of our favorites. Stochastic's great when you recognize channeling markets. MACD is going to be great when you recognize trending markets. So it recognized trending market, check out a daily 4-hour. If you're above or price is above or below the 200 moving average by a decent amount, consider whichever direction it is, then basically say, okay, we're going to sell or buy. Go to the 15-minute, even just look for things where it pulls back to the 200 moving average. And when it does that, it can be as simple as wait for the MACD to switch. When that does happen and occur, you go in that direction. It's a very basic kind of concept, but you'll probably have a little bit of success. And even if you run it in a demo and just test that alongside your own thing, see the differences. We'll start to learn that by just recognizing that trend and not countering, like a lot of us do scalping, you may have a little bit more success. You'd be surprised. Can you put these kind of strategies in MQL5? From Tim, yeah, you could definitely do that. I would say, well, it's going to be easy to do the moving average, and it's going to be pretty easy to see that the price is touched. And then I think you're probably going to have to get a manual signal. So you'll get like a signal that will spit out, and then you'd use it like an alert. A lot of basic indicators, because it'll be a little bit difficult to say, okay, take the trigger every time, and it will miss trigger, but definitely good for giving you an alert. And a few other questions just about a few people coming in a little bit late. Yes, you will get a recording of this video. So it'll be on Pepperstone's YouTube, and I believe they'll also send you one as a follow-up. And we use default MACD settings. Yeah, very important. All right, well, thank you very much for everyone attending. Hopefully that does help everybody tonight. And I know we got a little bit off topic about the scalping systems, but just the MACD one alone hopefully has given you guys some information. And we'll either see you in the next webinar straight after this on our YouTube channel or Pepperstone's one, or we'll see you in 2 weeks' time.
Yep, hopefully everybody will join us shortly. But if you've got any topics that you'd like us to cover, don't forget to send some information through to your Pepperstone representative, and they'll pass it on to us. So we want to try and cover topics that everybody is going to be really keen on. So I know we've got price action tagged in one of the ones coming up, but if anybody's got any suggestions, just let your Pepperstone representative know, and we will cover it in future webinars. All right, guys, thanks very much for joining, and yeah, we will see you all shortly.
See you all shortly. Thanks very much, guys.